have been watching commodities recently, just like crypto or anything else, you need to pay serious attention right now. Because what's happening in silver is not just price action. It isn't just big traders playing momentum. It is turning into something much, much bigger. A structural supply chain problem that most people are completely missing right now. And the difference between understanding this and ignoring it could be the difference between getting positioned early or getting destroyed trying to short a market that's being squeezed by physical demand. That's why today we want to break up what is happening. I know a lot of you probably are thinking, panicking with silver and gold investments. And today we are breaking down silver through a lens most people don't use. Not hype, not headlines that we see, not chart patterns, but market structure and physical supply chain dynamics, because silver is one of those markets where the screen price is only half of the story, in particular with silver and gold. So there are two groups in this market right now. We have traders, they treat silver like a chart, they see it rising and they say it's overbought, it has to crash. They're basically trading pattern recognition. And there is the group two, the second group, which is the real buyers. These are manufacturers, industrial buyers, supply chain managers, and they don't care about the RSI, they don't care about the moving average. They care only about one thing. If I order today, will the metal actually show up when I need it? That's the most important question that they're asking, and this is where the tension is being built. For the past couple of months, silver has been moving in a way that caught a lot of people off guard. It was trading around $50 or $60 per ounce. Then it pushed higher in no time, just in days, into triple digits, and it held very strong with a lot of volume above the $100 level. Gold has also been moving in a very similar manner, and it looks like the precious metals are entering this discovery phase. But here is the point. If you're only watching price, you're missing the bigger story, the bigger picture, because the real question isn't what silver is priced at today. The real question is, what does the delivery system look like? This is more important at this stage. And there are three major areas that if you're an investor, you need to focus on: exchange mechanics and margin charges, supply chain dynamics and physical availability, and narratives, and why they are creating traps. And then you need to answer one question for yourself. Are you trading silver, or are you witnessing a structural shift that actually will make you keep silver for a longer term? So the first topic, the exchange mechanics. This is very, very important because this is what's driving the crash that you saw yesterday and that you're seeing right now. Let's start with the margin requirements. When volatility spikes, exchanges, they raise margin requirements, and most people interpret this one way. They're raising margin to kill the rally and protect the big guys. Sometimes that's true, but not always. We need to consider something much deeper than that. What if it's not suppression? Why if that's risk management? Because a futures exchange isn't just a casino, it's a clearing system. And that system only works if enough collateral is posted and deliveries can be handled without breaking the system. Why I'm saying that? Because here comes the very uncomfortable part. Warehouse inventory is not the same as deliverable inventory. You have eligible inventory, which meets specs stored in warehouse, and you have registered inventory, actually available for delivery against futures. And when the second group, the registered inventory, which is the one actually available for delivery against futures, declines, when this registered inventory declines, it means paper market is operating with a weaker physical backstop. So the question becomes, how many paper claims exist for each ounce that can actually be delivered? And when the ratio becomes uncomfortable, the exchange has a serious problem. Why I'm explaining that? Because this is where the margin, the mechanics become very important. Most people think that margin is fixed, but in reality, exchanges can adjust the margin in ways that scale with notional value. Meaning, as silver rises, your losses increase if you are thinking about shorting the market, and your margin requirement increases too. So if you're short, you are losing money and you're forced to post more collateral while the market is moving against you. That creates compounding pressure. Eventually, shorts have two choices: add more capital to keep the position going and see the market move against you, or close the position. And closing a short means buying. Buying pushes price higher. So every spike isn't just price action, it's a stress test. And stress tests eventually expose weak points. So when you hear people saying margins were raised to kill the rally, you need also to consider that margins may be raised to protect the clearing system from delivery stress. And if the exchange is concerned about system integrity, imagine what industrial buyers are worried about. Their worries are much bigger. And if we have to be honest, in normal markets, most futures contracts, they never go to delivery. They get rolled, they get closed, or cash settled. But when long holders start acting like they want physical, the entire game changes. And when delivery activity looks heavier than normal, especially in months that aren't historically measured delivery months, that's not speculation, that's urgency, and urgency spreads quickly. And if we now try to connect the dots and connect that to the bigger macro reality, silver isn't just jewelry, it's industrial. And one of the biggest drivers is solar. The world has added so much more plans for solar capacity recently. And that's not theory, that's hardware. And silver is critical in conductive based electrical contracts, high efficiency connectivity. So even if silver is reduced per panel, let's say, the volume of production is so huge that still the silver demand will be high. It's not going to be reduced that easily. Most people think that China mines silver, but the bigger story is that China and Asia dominate refining and processing capacity. So even if the world mines enough, it has to be refined, it has to be processed, it has to be transported, it has to be fabricated, and supply chains don't just relocate overnight. So when export controls, licensing delays, prioritization systems appear. So in these conditions, when export controls, licensing delays, the prioritization system appear, the market doesn't need to be banned, let's say, the silver, to feel stress. Delays like that function like shortages because we have this just-in-time systems that we are striving for. And when in those systems we have delays, these delays, they become like disasters. It's equivalent to having a ban. We have a supply issue on a bigger scale, and most silver isn't mined because people are just mining silver, but silver is a byproduct of copper, lead, zinc. So even if price doubles, you can't just decide to mine more silver. Supply response is slow, permits are slow, refining expansion is slow. And that means, please focus here, when demand is structural and supply is constrained, price doesn't just decide to revert like what we see on the chart, just because it feels high and we are oversold. It really doesn't work like this. And I want to tell you about the retail mania excuse right now and trap. Silver is not being driven by retail investors. Yes, retail investors matter, but it's often used as some kind of lazy explanation, irrational explanation. It allows institutions to dismiss the move. It allows commentators to avoid talking about the real issues, physical availability. Because if this was purely speculative, you wouldn't see this much focus on delivery and inventory. You wouldn't see also so much focus on Trump gaining Greenland. I'll talk about that in another video. So it is definitely not speculation. And this is how people get trapped. They hear the headline stories that circulate. There is forced liquidation on this date, on that date, and suddenly everyone believes that the downside is guaranteed. They reduce exposure, they start shorting, then the date arrives and nothing happens. The market continues higher. That's narrative manipulation. So when you hear everyone has to sell because we are oversold, we've been going up for months now, it is so dangerous, ask, who is forced? Where is this flow coming from? What it would drive this move? Understanding underneath the surface. If you can't answer that clearly for yourself, you are trading and investing just stories, not actual structure. It's so dangerous to short silver right now, and I want to warn you because I know thousands, millions of people are shorting silver right now. There is a huge push online. I see it on X, I see it on social media. It's obviously going to crash. I've predicted that, go short, and so on. But the real risk explained is missing because in physical commodities, you can get squeezed by structure, not by sentiment. So if you're thinking about shorting silver right now, answer two questions. How much can you lose before you're forced to close? If you're forced to close, who is buying on the other side? Because the pattern is very simple. The crowd, the retail investors, are shorting. We see price spiking. We see shorts cover. Then price spikes higher than before, and this all repeats until the accounts are fully blown up. And we would see that happening. I'm sure in that. And all the data and what is happening is guaranteeing us this outcome. So the real question to ask yourself right now, and please drop your comments, drop your thoughts in the comments below. Do you think that the bigger risk right now is silver price falling or physical silver becoming unavailable? Because if you answer this question for yourself, you would know in which direction we are going. And these two are completely separate problems. Price falling is market to market, but physical unavailability is an operational crisis. Factories can survive volatility, but they can't survive missing inputs and missing deliveries and missing, as I said, missing inputs to keep building, to keep creating something that is needed worldwide. That's for me today. I hope you found this video helpful. As always, please, if you like my content, don't forget to like, subscribe, and share. That would be greatly appreciated. Thank you.